Well, this is my first monologue podcast, so take it easy on me today. I'm still working through some of the technology and just being on my own. So with that said, I'm going to jump right in. We're going to break this program down into essentially three categories today. The first category is going to be stock market data, and essentially I'm going to give you my opinion on where I think the stock market is, and then where it might be going in the short term, plus what we're doing as an advisory firm to manage through that. Then we're going to get into the macroeconomic backdrop. We'll spend a bit of time there, primarily just because there's a lot going on in the world right now. And so I'm going to try to do my best to make sense of it so that it makes sense to you. And then lastly, I'm going to get into geopolitics. So if you're not really into the whole political conversation, that might be one you might not want to hang in there for. But if you're interested in the way I see the world and what I think is happening, then stick around for that. We're going to go into some. I will say that the time that I spend there is going to be mostly on things that you probably haven't heard because it's kind of counter to the mainstream narrative. And so as a result, some of the stuff might be surprising, and you might find it hard to believe in the beginning. But over time, I think the case that I'll make is a pretty good one, and why it's important for you to get involved in this kind of stuff. So with that said, let's jump right into the stock market here. So what I've got on this chart that you can see on the screen is the S&P 500. We've got the blue line is the 200-day moving average, the red one is the 20-day, and the green one is the 50-day moving average. You can see that we kind of crossed on the 20, kind of messed around here with the green 50-day moving average getting close to the 20-day moving average. I'm sorry, the 200-day moving average. So my take on what you're seeing here basically is that we're still on a downtrend. We could see the market, if you look at this candle here, it's possible that the market could creep up somewhere in this space, okay? What I think we've had is a short-term bullish rally in a bearish market, and so you get those. And whether we crest this 4587 area, maybe make it all the way up to 4700, I don't know. I follow Darius Dale, 42 Macro. He's a great follow on Twitter. He's got a great subscription service, so if you're into doing things yourself, I would check out Darius. You can look him up at 42macro.com. He kind of calls the short-term high side at around 4,700. I think that's a little optimistic. It's not that he's saying he's going to get there. It's just the probable range. I tend to agree that that's probably as high as the market could get, and it's not likely to get up that high. More likely, I think we're just going to see things continue to deteriorate. So I follow Raoul Paul on his website, Real Vision. Raoul started off at Goldman Sachs, I think in their hedge fund division, and then went off on his own. He wrote the Global Macro Investor, GMI, and which is a newsletter and a subscription service that he kind of dedicates that, I think, towards hedge funds, or did anyway, and institutional investors. And now he's kind of developed this program for what I'd call more retail. But it's institutional grade research, which is phenomenal. And so this chart that you're looking at here, I think is really interesting. It's the 10-year Treasury that you can see the yields are starting to fall, just as the 2-year Treasuries are starting to go up. What this little crisscross here, if you will, is called the yield curve becoming inverted, which just means that longer-term rates are now moving below the short-term rates, which are moving higher. Historically, that's been an indicator of a recession. It doesn't mean we're going into another global financial crisis, although that's not off the table either, I'd say at this point. But more importantly, what it's suggesting is that the longer-term rate market sees the economy rolling over and things getting more difficult, while the short-term rate market is buying into this inflation narrative and ultimately what the Fed is doing. And so the Fed has definitely turned more hawkish, which if you're worried about inflation, that might be a good thing. But if you're worried about big picture economy, they might be doing the wrong thing at the wrong time. Not necessarily the wrong thing in a sense that they shouldn't be trying to address inflation, but they're just so far behind the curve that it's almost too little too late. And so they're going to obviously raise rates to try to fight inflation into a time where demand destruction might be taking place because of commodity prices and a whole bunch of other things we'll get to in the global space, the macro space rather. So the fact that the 10-year Treasury has dipped below the 2-year Treasury is not a good sign. And if you look at what he did here, he calls this his chart of truth. Again, thanks, Raul, for great research. But you can see that the 30-year bonds are kind of getting up to that upper end of the range. And while, like you've seen here and a couple times back here, certainly it could crest above the upper end, but it's not usually long-lived and likely to head back down. And again, if you think in the big picture that things are going to roll over, it would make sense, obviously, that the long-term rates would start to come back down again, because we'll have more recessionary trends and maybe even depressionary trends. It just depends on kind of the way things play out, both in Ukraine and Russia, but also some macro stuff as well, which again we're going to get to. So short-term basis, we're pretty bearish. One more thing I can point out here: the University of Michigan Consumer Sentiment Index has dropped dramatically. It's now as low as it's been since 2011, and you can see the trend is going in the wrong direction. Housing starts have started to slow down. I think they shrunk by 4% when the expectation was to have grown by 1%. So mortgage rates are back up over 4.5%. None of this is really good. So I think even in the short to intermediate term, the data is suggesting that things are going to be a problem. Obviously, with gas at $5 a gallon, or between $4 and $5 a gallon, depending on where you live, that could be a problem also. So from our standpoint, we follow the Howard Capital byline. Their byline, which is their algorithm, it's strictly math based, and it went negative back in January on the 24th. So that told Howard to take about a third of their portfolio out of the market and put it into cash. And I think actually right now they're closer to 50% in cash. And we're kind of at a crossroads because the market's pushed up and we're probably kind of in that overbought range. And while there may be a little bit more room to the upside, it's likely going to head back down. And so I'm hoping that the Howard algorithm doesn't trigger back in because it's getting close. But I think it'll get close, but it probably won't trigger again. And then I'll wait for the next trigger, which tells to go completely to cash. And I think that's more likely than triggering back in on the buy side. At least that's what it looks like from this vantage point. Again, that could change. I don't invest my clients' money based on what I think is going to happen. We use the math and we use time-tested systems to make sure that we're making the right decisions. So the good news is that if you're one of our clients, you've been spared a big chunk of the downturn, and you're in a good position, quite frankly, if the market continues to turn down, which I think is likely, and it could be quite a bit more. I think you're going to find that if your money's in our hands, it's in pretty good shape, and if it's not, you should think about maybe looking at us and opening that door. So, all right, that's probably all I want to cover on the stock market for now. I'm going to transition here, and we're going to get into the global macroeconomic picture.